Have you ever wondered how massive companies deal with a future that's, well, completely unpredictable? I mean, how do they shield their profits from just wild price swings? It turns out accountants have this really clever trick up their sleeve, a special kind of parking lot for managing financial risk. All right, let's get into it.
So here's the plan. We're going to start with the problem itself, price volatility. Then we'll introduce the solution, which is hedging. From there, we'll zoom in on something called a cash flow hedge and uncover the secret of the accounting parking lot, OCI. We'll even see how it compares to another strategy, and then we'll wrap it all up by showing you why any of this actually matters.
Okay, first things first. We have to tackle the core challenge that basically every business on the planet faces, the risk of prices changing all the time. The future's unpredictable, and that volatility can absolutely wreak havoc on a company's bottom line. To make this super clear, let's just ask a simple question. Imagine you run a cereal company. What's the one thing that might keep you up at night? Well, for starters, the price of your number one ingredient, wheat.
So let's put ourselves in the shoes of a company we'll call Kix Inc. They look at their production schedule, and they know that 6 months from now, they are going to need a ton of wheat. But what if the price of wheat doubles between now and then? Their costs would go through the roof, and poof, their profits could completely vanish. This is a massive, massive risk.
So how do they defend against something like that? Well, they use a financial strategy called hedging. At its heart, a hedge is basically a financial shield. It's a way to protect yourself from one kind of risk, like prices going up, by intentionally taking on the opposite risk. In this case, the risk that prices might go down. It's all about finding balance in a totally unbalanced world.
And the tool they use to build this shield is called a derivative. Now, I know that word can sound pretty intimidating, but the idea is actually simple. A derivative is just a contract, and its value is tied to or, derived from something else, like the price of wheat. A futures contract is a perfect example of this, and it's totally key to our story here.
All right, so now that we have the basic tool, let's see how it's actually used. We're going to focus on one very specific type of hedge that's just perfect for a situation like the one Kix is in. It's called the cash flow hedge.
A cash flow hedge is all about looking ahead. It's used to protect a company from price swings on a deal that hasn't even happened yet, but one they know is coming down the line, just like Kix's big wheat purchase.
So here's the play for Kix. They sign a futures contract today that basically lets them lock in today's price for all that wheat they're going to need on July 1st. Now, if the market price for wheat soars, their contract becomes more valuable, and that gain cancels out the higher cost of the actual wheat. See? They've built their shield. And right here, this brings us to the really interesting accounting puzzle. The price of wheat isn't just going to sit still until July, right? It's going to be bouncing around every single day. And that means the value of Kix's futures contract is also constantly changing. So, where on earth do the accountants record all these daily ups and downs?
Well, the answer is a very special place on the financial statements called Other Comprehensive Income, or OCI. And honestly, the best way to think about it is as an accounting parking lot.
So, technically speaking, OCI is a section inside of stockholders' equity on the balance sheet. You can think of it as a holding area, a temporary home for gains and losses that haven't been officially realized just yet. They're real, but they're just waiting.
So as the value of Kix's contract goes up and down, all those changes get parked in OCI. And this is the really crucial part. It keeps all of that volatility completely off the main income statement. It prevents all those temporary, paper gains and losses from making the company's earnings look like a roller coaster every quarter.
So why do this? I mean, what's the point? It all comes down to a core accounting rule called the matching principle. This just says that your expenses should be recorded in the same period as the revenues they helped create. By parking the hedge's results in OCI, accountants make sure that the financial impact of that hedge hits the income statement at the exact same time the wheat is finally used and sold as cereal. It's a perfect match.
So let's just walk through the whole journey one more time. Step 1, Kix enters the futures contract. Step 2, as its value changes day to day, those gains or losses get parked in OCI. Step 3, Kix actually buys the wheat. And finally, step 4, when the cereal made from that wheat gets sold, the amount that was parked in OCI gets released and moved over to the income statement to offset the cost. Simple as that.
Now, to really get why a cash flow hedge is so special, it really helps to compare it to its sibling, the fair value hedge.
A fair value hedge, you see, is used for a totally different reason. It's not for something you're going to buy in the future. It's to protect the value of an asset or inventory that the company already has sitting on its books.
The critical difference here is the purpose. A cash flow hedge is for a future, forecasted transaction. A fair value hedge is for an existing asset. And that one difference leads to a massive change in the accounting. With a cash flow hedge, gains and losses are deferred in OCI. But with a fair value hedge, nope, they go straight to net income, right away.
And this whole immediate recognition thing is so unusual that the source material literally points it out, saying, "Note, this is very different than normal accounting rules," which just goes to show you how unique these accounting treatments really are.
Okay, so we've been through all the mechanics, but let's bring it home with the big question. Why does any of this matter to you if you're an investor or an analyst?
The impact of using OCI for these hedges is actually huge. For starters, it smooths out a company's reported earnings, so their performance isn't jumping all over the map just because of temporary market jitters. This gives investors a much clearer, more stable picture of how the company's real core business is actually doing, all while sticking to that all-important matching principle.
And you should know this isn't some tiny, obscure corner of the financial world. Back in mid-2020, the derivatives market, that's the market for the tools used in hedging, was valued at a mind-boggling $607 trillion. So yeah, understanding how these things are accounted for is pretty essential to understanding the global economy.
So, the next time you're looking at a company's financial statements and you see that line item, Other Comprehensive Income, you'll know it isn't just another number. You'll know it's a story about the future, about managing risk, and about a company's grand strategy to protect itself in a really uncertain world. So the question is, what story are you going to look for?